Charlie Munger, the king of doing almost nothing and still finding a way to become rich. He has only bought one stock for the investments that he manages at the Daily Journal Corp over the past 10 years, and that stock is Alibaba. In the past 10 years, he's only invested in very few companies: Berkshire Hathaway, Costco, Leilu's China Fund, and these three companies have made him very wealthy. They've made him into a billionaire. However, these three stocks he bought a long time ago. Alibaba is a recent buy. So Charlie, why do you like Alibaba?
Well, of course, only the future knows who's going to be right. But China is a big modern nation. It's got this huge population and this huge modernity that's come in the last 30 years. We invested some money in China because we could get more value in terms of the strength of the enterprise and the price of the security than we could get in the United States. When you buy Alibaba, you do get a sort of a derivative, but assuming there's a reasonable honor among civilized nations, that risk doesn't seem all that big to me.
Why would anyone as smart as Munger or Buffett consider investing in China or any of the Chinese companies?
Well, we did it for a very simple reason. We got more strength per dollar invested. In China, the companies we invest in are stronger relative to their competition and priced lower. That's why we're in China.
So let's dig into Alibaba. Let's learn a little bit about what the company does and then go into the financials. Let's see, is this company potentially undervalued? Is it overvalued? Is there a potential deal here? Because it's not just Munger, there's a lot of other value investors buying the stock. Maybe there is an opportunity out there, or maybe it's too risky. So I really like to start these stock analyses with a quick breakdown of the business, because I do believe that if you don't really understand the business, you're going to be at a serious disadvantage to most investors who do understand the business. If you don't understand the business, how will you know what type of income that this stock, that this business will produce into the future? How will you know the stock's true intrinsic value? If you don't understand the business, you're more likely to be speculating or gambling in the stock market, but not investing, certainly not investing the Warren Buffett way. So Alibaba is split into 7 business segments. They have China commerce, they have international commerce, they have local consumer services, they have CNOW, they have their cloud computing, they have digital media and entertainment, and then lastly they have innovation initiatives and others. So the one that makes up most of their revenue, 70%, is China commerce. So this is the likes of Taobao, Tmall, Freshippo, Alibaba Health, 1688.com. These are kind of like China's version of Amazon, where they sell products around China online through not just one website, but mainly the two, Taobao and Tmall. And you can get all of these products delivered to your door. Second segment is cloud computing, which makes up about 8% of the revenue. So the cloud basically just means you, the customer, uses Alibaba's technology and computer power to serve your needs. You go online, you use their computing power to serve whatever thing that you want to use, whether that is their database, security features, data analytics if you're a big company. And also, do not overlook this segment, because by 2025, the size of China's cloud computing market is expected to reach 1 trillion RMB. That's China's currency, which is 3 times the size of the current market. 3 times the size. That means if Alibaba can just maintain or even grow their market share in this segment, they can make a lot of money. Who knows, that 8% could move to 24% of their total revenue. Number 3 is international commerce. That makes up 7% of revenue. This is websites like AliExpress, Lazada, where people outside of China can purchase products and get them delivered. International segment for e-commerce. Then you have CNOW, which accounts for around 6% of revenue. So this is for logistics and managing the supply chain and the delivery of the products. And if you do want to learn more about this segment, just go and watch this video here. 5 is the local consumer services segment. This includes LA.me, which is a services and on-demand delivery platform. You have AMAP, that's a provider of digital map, navigation, and real-time traffic information. And you've got Fliggy, an online travel platform. So it's kind of like how Google have Google Maps and Uber have Uber Eats, or Booking.com allow you to book accommodation. Alibaba have all 3 of these, but the Chinese version, and it's just one company, it's just Alibaba. 6, you have media and entertainment. This includes Youku, an online long-form video platform. Then you've got Alibaba Pictures, an internet-driven platform covering content production, promotion, and distribution. So it's kind of like China's YouTube or China's Netflix as well. And then lastly, you have innovation initiatives and others, which makes up such a small percentage of revenue. It's not even worth digging into, but it's kind of like Google's other bets segment or Alibaba's other bets that they're working on, that they're looking to grow into something big, but they're still very small right now. So that is Alibaba's business in a nutshell, but just remember that their core is e-commerce and cloud computing as well. That makes up 80% of their revenue and most of their earnings. So you need to think, well, how is e-commerce going to perform in the future for China? How will China as a whole do as a country? Will they continue to buy things online? Will that keep growing? I think it will. How will cloud computing do over the next 10 years? As from all the trends that we see throughout the whole world, it's looking to grow by a lot. So these are the types of questions we need to be asking as investors. Okay, so I just want to say good work if you watched that and you actually got to understand Alibaba's core business. You're probably ahead of 80% of investors who generally don't look at the stock as an actual business, but more of, well, it's a ticker symbol where the price goes up and down. What a true value investor does is they separate the price of the stock to the value of the stock, and then they simply look to pay at a price below the true value of the stock. It's actually pretty simple, but people don't like it simple. They prefer it complicated.
And the reason that our ideas have not spread faster is they're too simple. The professional classes can't justify their existence if that's all they have to say. I mean, it's all so obvious and so simple. What would they have to do with the rest of the semester?
So Alibaba's business, let's keep this separate from the price. Their business has been up and down. Okay, you look at their revenue. The revenue has been extremely good. It's more than doubled, almost tripled since 2019, from 56 billion to 130 billion in 2022. But their free cash flow, how much cash that they keep at the end of the day, has been up and down. 15 billion in 2019 to 19 billion to 28 billion, then back down to 14 billion, then back up to 23 billion. Now let's use this data to calculate the value of the stock, because price is what you pay, but the value is what you get. So to do this calculation, I'm going to go to www.buffettinvestors.com. So this website is really good and easy to use for calculating the intrinsic value of a stock. Anyone can use this website for free right now, and there's also a premium version. So I'll leave a link to that in the description if you want to use it yourself and start to calculate the value of different stocks that you're interested in. It's a lot better and easier to use than Excel. So these were our historical cash flows over the past 4 years. Let's say that for our starting point in 1 year's time, we can do a free cash flow of $20 billion. That seems pretty reasonable since we did free cash flow of 29 billion in 2021. Now, if we just take a look at the current market cap of the stock, that is 275 billion for the entire company. This means we're paying at a multiple of 14 times the free cash flow on the stock, meaning if there's absolutely no growth over 14 years, we will get our money back at the current price. 14 years it will take with no growth in free cash flow. But no growth over the next 10 years is not really going to happen, because in the past 10 years, free cash flow has grown at 30.8%. In the past 5 years, growth was 11.2% despite the pandemic and all of the economic headwinds. So let's say that in the future, with China, the country's overall growth, with the growth in e-commerce, with growth in cloud computing, that they are able to achieve a 10% growth in free cash flow over the next 10 years. Our years to forecast will be 10. We'll be doing a 10-year analysis, and we'll say that we want also a 10% return each year for our discount rates. And we'll use a reasonably low terminal PE of 13 because they're a Chinese stock and all of that, so I want to be a bit conservative. In this case, we get a value of $418 billion for the entire company, or $158 a share. This basically means if the price was $158, then you would get a 10% return each year, assuming that the growth rates that we put in are achieved. And right now their price is only around $100 a share, meaning they are quite undervalued based on these metrics. So that's just from the fundamental side of things. Also, from the sort of more qualitative side of things, I've been listening to the earnings calls recently. It's a pretty boring listen. I'm not gonna lie. Their management, just because of the language barrier, it is a bit more harder to understand and a bit more boring. I will say that one of the things that annoyed me was that I didn't like when listening to these earnings calls was that their management bases results on EBITDA, earnings before interest, taxes, depreciation, and amortization. Charlie Munger, what do you think of EBITDA?
Yeah, I think you would understand any presentation using the word EBITDA if every time you saw that word, you just substituted the phrase bullshit earnings.
So yeah, that's just one thing that annoyed me. I want to look at earnings, the true earnings, not earnings before taxes, not earnings before depreciation, before amortization. Those are real expenses. I want to know your true profit, not your fake profit. That's just one thing that annoyed me, and I don't like that way of measuring results. But with every stock, there's always going to be one or two things that are not perfect to my taste. But overall, just from the numbers, they are a cheap company relative to the cash flow that they bring in. They're selling for still a cheap price right now. But that is assuming that nothing goes wrong in the future. And that is a big assumption. Alibaba, they are a Chinese company. They have to deal with the Chinese government and all of that craziness that comes with it. They have to deal with the US government potentially delisting them. As was said on the Value Investors Club, investing in China is not for the faint-hearted. Read the risks section first and then reread it again. There is potential opportunity here. Munger sees the opportunity, Pabrai sees it, a lot of value investors like Alibaba stock. But the big question is, are we willing to take on the risks that come with China and Alibaba? And that's the question that all investors have to ask themselves. And if you are prepared to take on the risks, if you don't think the risks are as bad as people state them to be, which is kind of Charlie Munger's viewpoint, he doesn't think the risks are that much, well, then you're getting a very good quality stock that is delivering very good numbers relative to the price that you pay for the stock. So, such an interesting company.